Tell me, are you a homeowner feeling a little concerned about how inflation has dwindled down your savings account and possibly have increased up your credit card balances? First off, I want you to know you are not alone. I'm going to show you over the next few slides some data that's going to help prove this to you. The next chart that we're going to start with shows how people's personal savings rate compares based off pre-pandemic compared to after the pandemic, and it came down about 10%. While credit card debt continues to go up. We're going to discuss that a little bit later. But then we had the recession in the pandemic, and the government gave us a big stimulus check. Now, if you recall, everything was shut down then, so people couldn't spend that check and instead decided to put it in the bank and save it. Next came another stimulus check. And guess what happened this time? We are still stuck at home. So people decided instead of putting it into the savings account, let's start paying off these high interest rate credit cards. And that was really good. So let's go on to the next chart. We started to see credit card debt decrease while credit scores were still increasing. But wait, this is where things started to go south for us. As soon as things started to open up a bit, we got another stimulus check. That one came around Christmas, and that one we used completely differently because we could spend that money and put some presents under the Christmas tree. But then we got another one in March. We got another stimulus check in March. And guess what? People spent that even faster. By this time, a new behavior and lifestyle developed while the cost of goods was increasing, but several did not want to go back to their old lifestyle and just kept spending those stimulus checks as if they were going to just keep coming in. Why is this a double whammy? This is a double whammy because just a year ago, you had credit cards in the 14% interest rate, and now we have 20% interest on credit cards. How can anyone be able to pay off high interest rate credit cards at a 20% interest rate, especially when the credit card debt just keeps getting higher? Let's talk about car loans because that's not the only thing. Car loans, did you know the average person pays $800 a month on a car payment? And actually, that has actually doubled in the last 3 years. 1 out of 6 people have a car payment that's over $1,000. And this number would technically be higher, but now most are choosing financing terms of 6 years or more. This is exactly why now is the best time for cash out refinance. And I'm going to use math to show you why. Let's take a look at how much equity in homes has evolved over the years. During the housing bubble of 2008, if you will look here on the chart, you had 19% equity and 81% loan to value. Compare that to today. We have equity in our homes. Today, the average homeowner is sitting on 8% equity with 42% loan to value. Mind blown. This means, my friends, you have savings. You have savings. It's just locked up into your home. Now is the time to leverage it. But I know you're saying, Karen, why would anyone trade in their 3% interest rate to pay a rate of 6.5 or more? Let me show you. The math will show you. What are you paying in aggregate from all household debt? Here is a recent client example I want to show you the real data. As you can see in this example, our client bought a home 5 years ago at $500,000 with a loan amount of $400,000 and that beautiful rate of 3%. Now assume the house has gone up in value some while also having slightly smaller loan amount due to the normal amortization of the home. Using all worst case numbers in this comparison, if we are talking about a cash out refinance, then we must also factor in closing costs. I'm going to factor in about $4,000 in closing cost. Why would anyone in their right mind trade in that 3% rate for an extra $577 a month? Those people that are paying high interest rates on their credit card debt. Those are the people that want to get rid of that 3% and take the higher interest rate. Take a look at their debts and what those debts are costing them each month. Let's just go another slide. We've got a Visa, MasterCard, Discover, and we've got that car loan. Take a look at these. Now, in order to refinance, we need to know the home's current value to determine how much of your home's piggy bank savings account we can pull from to see if it's worth executing this strategy. Let's take a look. The client started with a 55% loan to value. So that room to go as high as 75% loan to value, which would pay off all of their higher interest rate debts. So yes, their mortgage went up $577. With this strategy, we just saved them $1,100 a month in cash flow. Nice. Look at that number, nearly $1,100 a month in cash flow. Do you know how much relief that was to them? Do you know how much money you need to make each year to just generate $1,100 a month? For many people, it's $25,000 a year. This is like getting, my friends, a $25,000 a year raise. Now, here is how my mortgage brain kind of works. I kept going with this. What if they didn't need that $1,100 a month? What if instead they applied it towards their principal balance on their mortgage, as this was money already being spent? So take it, they paid off their credit cards, they paid off that car loan, they have an extra $1,100 a month. So instead of just, yay, I've got all this money, what if they just put that towards their principal balance? You can do that. What if instead they use that along with this strategy? They would now be able to pay off their mortgage in as little as 4 years and 10 months, which saves about a year's worth of payments. This could mean 10 years sooner to your retirement with an extra $263,000 in your home. Because, think about it, because if they had kept their 3% mortgage, then technically 14 years and 10 months from now, they would have a mortgage balance of $264,000. The math doesn't lie, my friends. The truth is in the data, and I've showed you the data. So if you're worried about your finances, are you worried about your retirement, then now is the time to leverage your home's equity, that savings is locked up in that home of yours. This could save you money, and we can also help you strategically plan those savings to apply back to your mortgage. Not to mention, you'll be able to refinance as soon as rates do come down, hopefully in the next year. If you have any questions on any of these strategies, call me, check out the link in my bio, or leave a comment below. We are always here. Mortgage Mentor, always try to help you make it to the closing table with ease. Talk to you later, guys. Bye-bye.